Today we'll start with security analysis. Okay, what do you mean by security analysis? Security analysis means the systematic analysis of prices of securities so that an investor can take decision regarding the purchase or sale of security. Okay, in security valuation chapter, what we learned is that what is the intrinsic value of the security and whether we should buy it or not. In security analysis chapter, we will see what we'll see is that we'll see the systematic analysis of prices of security. We are getting the proper value. Okay, security valuation chapter, it dealt with your fundamental analysis. In security analysis chapter, we will see about technical analysis. Okay, so what do you mean by technical analysis and fundamental analysis? Fundamental analysis means using your financial data or using your historical data of your financial reports to make decision on the price of security. Okay, that is your dividend based model. Okay, your earning based model, or let's suppose that means your dividend is the main factor for the prices of security. But what does technical analysis say? Technical analysis say that price is the king. Okay, so with by using prices, past prices of the security, we will be able to predict the securities performance. Okay, we'll be able to make proper analysis of the security. Okay, so how do we do it? Decision making by technical analysts using moving averages. Okay, so what is moving averages we'll see later. Okay, for now just be with me. Arithmetic or simple moving average, it is AMA or SMA. It is simple average of share prices of the last n number of days. Okay, calculation of AMA or SMA is how we'll do it. Sum of total share prices of last n number of days divided by number of days. Let's suppose for the last previous 5 days your share prices was 100, 105, 103, 102, 101, 104. Okay, so we'll divide by 5 and we'll see the price. Okay, it is simple average. Okay, so why is the name not simple average and why is it simple moving average? Because we'll see just 5 previous data. Okay, for today if I calculate 5 days data, I'll do it from, let's suppose today is 20th. Okay, so 20th, no, so last 5 days 15, 16, 17, 18, 19, 20. Okay, sorry, 16, 17, 18, sorry, 15, 16, 17, 18, 19. Okay, for 5 days I'll see. If tomorrow I'll do it, what will I see? 16, 17, 18, 19, 20. Okay, my averages will move according to my data. Okay, my first date will be moving. Okay, so that's why it is moving averages. We'll just see past 5 days data. Okay, or the whichever number of days it is given in question. Next, exponential moving average. Now what does this say? This theory says that your previous 5 days data, your okay, 5 days is very short period. Okay, let's suppose we are taking a data for 200 days. Okay, let's take a data for 200 days. Do you think that the first day of the 200 days is as important as the yesterday? No, right? Because the previous 200th day, okay, the first day of the 200 days, that till now very much change would have been occurred in the market, right? There will be very much change, there will be more information in the market, there will be much news in the market. Okay, so according to EMA, that data is not that relevant. Okay, that first day of the 200 days is not that relevant, but yesterday's data is very much relevant. Okay, so what it does is that it takes previous days EMA. Okay, we'll have to start at some point. Okay, we'll take previous days EMA plus closing price of share price today minus your previous day EMA into your exponential factor. What is our exponential factor? It is 2n plus 1. So how did we derive with this formula 2n plus 1? See, what we are doing is yesterday's data is carrying more weight. Okay, yesterday's data is very much important for us. Okay, so we'll do what? We'll give it one more day. Okay, we'll give more weight to it. So we'll do plus 1. Okay, plus 1. And why is there n plus 1? Because if I am giving more weight to the previous day, that is the yesterday, so earlier the days was only 200. Okay, now since I am giving extra weight to the yesterday's factor, so that's why n plus 1, 2n plus 1. Okay, or else you can write it as 1 plus 1 divided by n plus 1, whatever is your thing. Okay, n is the number of days for which the average is to be calculated. In our case it was 200, and the value of exponent can be given in question also. Okay, this factor can also be given in question, this exponent factor. If it is not given in question, then calculate. There are some notes given here. AMA and EMA cannot be calculated for number of trading days. Okay, for no trading days. If on a certain day there is no trading happening, that is your Saturday, Sundays, or your any holiday, Diwali, Holi, okay, on that days your market is not open. So for that day we cannot calculate AMA and EMA. Okay, analysis on the basis of A and EMA. Okay, if it is increasing day by day, if your AMA and EMA are increasing day by day, then it is uptrend. It means market is bullish. Take long position in the share. Okay, then you have to buy the share. If it is decreasing day by day, that is, let's suppose it was 1.1 on the first day, 1.0 on the second day, 0.9 on the third day, it is decreasing, right? So it means what? The market is bearish. Take short position on the share. That is to sell share. Okay, I have already explained to you short position in the previous portfolio chapter. Last part we have seen. Okay, I'll explain it to you more in a more detailed way in derivatives chapter. Okay, so this was one kind of question. We'll see. This was the concept. Okay, we'll see questions regarding EMA. Okay. See, here they have given some data. Okay, we'll take this question only. This was given as homework. We'll take this question. Okay, no, we'll take this question. Here they have given exponent value. We'll take this question. Okay, I'll just explain you this first question afterwards. Okay, the first EMA question number 1. Closing values of Nifty index from 3rd day of the month to 12th day of the month is given as follows. Okay, days are 8. Okay, this is my number of days. The date is given. Okay, date is irrelevant for me. And closing values of Nifty. Okay, every day some value is given. Okay, now simple moving average of Nifty index for the month of December 2022 was 174 171 Okay, so we are required to calculate the value of exponent for 15 days. Okay, what is my exponent value? What is exponent value? It is 2 divided by n plus 1. So 2 is in the numerator, and what will be in the denominator? It is my how much? 1 2 3 4 5 6 7. They are asking us to calculate the value of exponent for 15 days EMA. Okay, for 15 days. My n is 15. Okay, my n is 15. So 15 will take previous 15 days data. Okay, for calculating the this thing. Okay, current values. So 15 plus 1, 16. 2 divided by 16 will get 0.125 as my exponent value. Okay, next, the exponential moving average of Nifty during the above period. Okay, the exponential moving average of Nifty during the above period. Okay, so how will we do it? First we need to have one EMA. Okay, do we have EMA? Do we have EMA? Yes, it was 17174. Okay. So on the 3rd of January 2023, we are having what? Let's assume that 1st and 2nd will be no trading day or holiday. Okay. So we'll take previous day EMA as 174. Okay. So if I have to solve it, see, my previous day EMA is what? 17174, right? This is my previous day EMA plus my closing EMA, my closing date. What is my closing value? It is 17626, right? 17626 minus my opening EMA, it is 17174 into my exponent value, that is 0.125 or 2 divided by 16, right? So what will we get? 17626 minus 17. I'm getting it as 17230.5. This is for the 3rd of January. Okay, so I'm getting it as 17230.5, right? So like that we have to calculate for everything. Okay, for the 4th, 5th, 6th, we'll have to just put the values and the formulas and we'll get the answer. Okay, for here what will be my previous day's EMA? It will be 17230.5. okay, so we have calculated this. Analyze buy and sell signal on the basis of your calculations. Okay, should we buy or sell? If you see my EMAs, it is what? 17230.5, 17302.5, 17380. It is increasing day by day. Since it is uptrend, so we should book a long position. Okay, it is giving us bullish signal when the actual price of the Nifty, in this case, under consideration, the price of Nifty never breaches the 15-day EMA line. In fact, it is hovering around the 15 days EMA line only. Okay, so we should take long position. Next, question number 2, it is homework. It is very much easy. It is based on the first sum only. Okay, they have directly given us exponential moving average. We have to what? We have to calculate exponential moving average of the Nifty during the period above. The previous day exponential moving average can be assumed as 15,000. Okay, 15,000 has been given here. So we have previous days also. So will we calculate 15,000 plus 14,522 minus 15,000 into my exponential moving average. Okay. Then we'll do. For no trading days, you cannot do anything. So we cannot, we will not calculate here. We'll calculate for the rest periods only. Okay. So this was fairly easy. You can do it. Okay, this was EMA. Next what we have here is efficient market theory hypothesis. Okay, efficient market theory or hypothesis. Okay, what does this theory say? It was given by Yugen Pharma. Okay, it is this name is important for your theory part. Okay, in theory part we have this name. Okay, so what does this theory says is that according to this theory, efficient market means a market in which investor cannot forecast share prices by using technical analysis. Okay, so what does this theory say is that what is technical analysis? It is the prediction of the share market, that how it will move based on the previous prices. Okay, it is based, technical analysis based on that history repeats itself. Okay, it is based on the assumption that history repeats itself. Okay, so if you want to have efficient market means what? Nobody can earn profits by seeing the previous data. Okay, past prices. That is your technical analysis. That will mean my market is efficient. Okay, if you are unable to gain any profit by using previous past data, then it is known as efficient market. Okay, there are three levels of market efficiency. What are those? It is, the first one is weak form of efficiency, the second one is semi strong form of efficiency, and the third one is strong form of efficiency. Okay, what is weak form of efficiency? It is that share price, in weak form of efficiency, what happens is that you cannot earn profits by using past data. Okay, by using past prices of the market, that is, you cannot do technical analysis, but you can earn profits by using fundamental analysis. Okay, so what does weak form of efficiency reflect? Weak form of efficiency, if everyone knows, I'll take an example. Okay, let's suppose the price of let's suppose the price of Reliance share is 2600. Okay, Reliance share is 2600 in the market, it is trading, okay, 2600. Now what is happening here is that there are many, in the market there are many technical analysts. Okay, technical analysts, everyone is analyzing their technical data, that is the past prices. Okay, the graph they are analyzing. Okay, the graph they are analyzing, everyone. Okay, there are set rules in the graph, right? So everyone is analyzing the market, and let's suppose if it is in the trough point, okay, if it is in the deep point, okay, now everyone is analyzing that it will go up, so they are investing money in here. Okay, so now here it will reach. Now at this point, what will happen is that this point will already have the effect of market, right? The effect of technical analysis it will have. Now here, after that, everyone is having knowledge of technical analysis, so it will not be used to calculate the prices. Will not the prices is already reflecting the technical analysis points. Okay, so that's why it will be irrelevant. Okay, share price reflects all information of past prices of the share. Okay, that is the technical analysis. So you can earn profits only by using fundamental analysis. What is semi-strong form of efficiency? It is that where technical analysis and fundamental analysis. Okay, let's assume that both the everyone in the market is aware of technical analysis, and they are also aware that technical analysis not working, so they are technical analysis not working, so they are moving towards fundamental analysis. They are learning fundamental analysis. When they learn fundamental analysis and invest according to it, then the prices reflecting in the market will be the prices will be having. So this form of market, so in strong form of efficiency, only your private information can save you, that is your insider trading can save you, which is illegal. Okay, in India it is illegal. SEBI prohibits insider trading. Okay, and next one is your strong form of efficiency, which means that share prices reflects all information of past prices. Okay, and other publicly available information. This strong form of efficiency, it means that all the effects of technical analysis, fundamental analysis, private information are already given effect to it. Okay, so there is no one can earn profit in this market. Okay, no one can predict the prices. Okay, this is strong form of efficiency. But in actual practical world, semi-strong and strong form of efficiency are not there. Okay, we can achieve weak form of efficiency, but semi-strong and strong form of efficiency cannot be achieved. Okay, so how do we test the weak form of efficiency of the market? Okay, this is only possible. Okay, so how do we achieve it? Okay, we do it by run test. Okay, run test and auto correlation test or serial correlation test, we'll see it later. Okay, we'll see first run test. What is run test? Okay, let's suppose there are some prices of the share given. Okay, so what we'll do is we'll see first. Okay, 500 to 520, the prices are increasing, we'll do plus. Okay, now 520 to 530, the prices are increasing, plus. Okay, and next the prices are decreasing, minus. The price is increasing, plus. The price is increasing, plus. Okay, here the number of, now we'll check how many times plus is there. Okay, before minus. Okay, so this is one run. Okay, this is, then comes minus, this is one run, and plus, this becomes one run. So what is the total number of runs? It is 3. Okay, so what do you mean by run? Run is how many times plus is coming continuously, or how many times minus is coming continuously. Okay, for market to be in weak form, number of runs should be near to average. It should not be either very high or very low. Okay, so the number of runs should not be 2 or 1, or it cannot be 10, 20. Okay, then also it is waste. It should be near to average. Okay, then only we will consider it as weak form of efficient market. Now step 2. Now we'll determine the number of plus signs in the market, in the price movements. So how many plus signs did we have? 1, 2, 3, 4. Okay, so 4 will be, we'll denote it by N1. Okay, then we'll do all the minus signs. We'll denote it by N2. So how many minus signs did we have? 1, only 1. Okay, then we'll take average of runs. Okay, so what is average sign? It is mu. Okay, average is also denoted by mu. Okay, so mu runs, it is, you have to by heart this formula. Okay, there is no derivation for it. I don't know the derivation. Now you have to just by heart it. Okay, so how do you calculate the average number of runs? It is 2 n1 plus n2 divided by n1 plus n2 plus 1. Okay, above we have multiplication, below we have addition. Okay, 2 into n1 plus n2, n1 into n2 divided by n1 plus n2 plus 1. Okay, we do it. Next, calculate standard deviation of the number of runs. How do we calculate standard deviation? We do it by, how do we calculate in Markowitz's portfolio theory? We take average minus my actual return, right? So here also we do it. Okay, but here what do you mean by 1? 1 is your numerical 1. Okay, mu minus 1 into here mu minus 2. Okay, so we divided by n1 plus n2 minus 1, we do it. Okay, so why do we do minus 1? Because above we took 2, right? We took n1 minus 2, so we'll do, to equalize it, we'll do minus 1 here. Okay, and we'll do square root of it. Because it is standard deviation, we'll do square root of it. Okay, next, calculate the range in between which the runs should be reflect the weak form. Okay, we'll define a range. Okay, there will be upper limit and lower limit. Between it will be our weak form of efficiency. Okay, so how do we define upper limit? It is mu plus your standard deviation into t. Okay, your t value will be given in question. Okay, what is your t value? T value means standard deviation में कितना time change आ सकता है because of error in our estimation. Okay, so t value will be given in question. So standard deviation into t, mu plus if we do, we'll get upper limit. Mu minus if we do, we'll get lower limit. As simple as that. Okay, mu plus standard deviation into t is your upper limit. Mu minus standard deviation into t is your lower limit. Okay, now t value will always be given in question. Okay, which is to be taken from standard t table at particular. Okay, significance level and degree of freedom, probability or chance of having error in our estimation. It is as per the discretion of the person performing the test. Okay, so whatever value we can take. Okay, t level, and how much confidence do we want? We saw in risk management, right? How much confidence do we want? 99%. So as per that we will take the t value. Okay, and the degree of freedom, that is the data used in the standard deviation calculation, that is n1 plus n2 minus 1. Okay, so we gave only that much freedom, n1 plus n2 minus 1. Okay, this is not that relevant. Okay, now regarding this we'll see a question. Okay, number of runs, run test. Okay, so there is only one question in the module. Okay, it will not be asked in exam, it is okay. Now how will we do it? See, 2800 was the value. Okay, and here we had what, we are doing minus. Okay, so minus is the first, then it is increasing plus. Okay, then it is increasing plus. Okay, like that we have to do for everything. Okay, and then we'll calculate the step 2 is what, number of runs, n1 is what, number of plus signs. Okay, so how do we do it? We'll count. Okay, 1 2 3 4 5 6 7 8 9 10 11. I have 11 plus signs. Okay, that is my n1. Now we have to find n2, that is your number of minus signs. It is 1 2 3 4 5 6 7 8. Okay, we have 8 minus signs. Now we have to just put it in the formula. So what is my mu value? It is my 2 into n1 into n2, okay, divided by n1 plus n2 plus 1. Okay, so 2 into n1 plus n1 into n2, so 2 into n1, it is my 11, and my n2 is 8, divided by my number of runs, that is 11 plus 8. Okay, 11 plus 8 is 19, 19 plus 1. Okay, so 10.26 is my mu. Okay, my mu is 10.26. This is my average value. Next, now we have to do what? Now we have to find the deviations in it. Okay, so how do we find deviation? First we do mu minus 1 and mu minus 2. Okay, we'll multiply both of it. Okay, we get a value 76.51. Then we do what? We do n1 plus n2 minus 1 in the denominator. So 11 plus 8 minus 1. Okay, 76.51 divided by, and we do what? We do square root. Okay, so this is my standard deviation, 2.06. Am I getting the same answer, 2.06? Yes. Okay, 2.06 I am getting as the standard deviation. Now what we need to do? We need to find the upper limit. So how do you find the upper limit? Is that t value given in question? Yes. You are required to test the weak form of efficiency by applying the run test at 5% and 10% level of significance. Okay, there is two significance level, that is 5% and 10%. Okay, that is as per our discretion, but they are given here. Okay, the t value of 5% is 2.101. Okay, at 18% degree of freedom. Okay, this information is not relevant. Okay, 18% degrees of freedom is not relevant for us. We have to just do what? 2.101. We got the t value. Okay, 2.06 into 2.101. Okay, so this value we are getting as standard deviation into t. Okay, minus what we do? Minus we do mu. Okay, 10.26. so this will be my lower value. 5.93 will be my lower value. So what will be my upper value? 2.101 into my standard deviation, 2.06 plus 10.26. This will be my upper limit, 14.58 and 5.93. See, 14.58 and 5.93 will be my upper limit and lower limit. Okay, so between this, if my value falls, if my run falls, we'll say it is in the weak form of efficiency. Okay, so what is my R value? My R value is number of runs. What is my number of runs? Number of runs is, we did not calculate, right? So this is 1. Okay, this is 1 2 3 4 4 5 6 7 8. Okay, we have 8 runs. Since this is falling between the 5.93 and 14.58, it is reflecting weak form of efficiency. Okay. So next we will take the level of significance as 10%. Okay. So what is the t value? It is 1.173, 1.734, 1.734 into what? Into my standard deviation 2.06 minus 10.26. My lowest value is 6.68. Okay, my upper value into 2.06. Okay, plus 10.26. Okay, 13.83 is my upper limit. Since my runs is 8, so it is falling between the both the values, so we will consider it as weak form of efficiency only. Okay, both these are weak form of efficiency. Now we'll move on to autocorrelation test or serial correlation test. We'll see the concepts. Autocorrelation test. First step, calculate the correlation between closing prices of share of a period by dividing the period into two. Okay, they have given two sets of period. Okay, of the same share they would have given two sets of period. Now what we do is that we'll divide the period by 2. Okay, let's suppose they are given data for 20 periods. Okay, so we'll divide the periods by 2. Okay, so first period will be 10 years, 10 period, and second period will be, second data will be of 10. Okay, so we'll treat two periods as separate shares. Okay, and then we'll calculate correlation between the prices of these two periods. Okay, it is like your like your portfolio valuation, portfolio management. If correlation between the closing prices of two periods of a share as calculated in step 1 is near 0, then it reflects weak form of efficiency. Okay, so 0.2, 0.3 minus okay, minus 0.2, 0.3. Okay, so if it is near to 0, then we will consider it as weak form of efficiency. If it is above 1, okay, 1.2, okay, something, then if it is more, okay, not near to 0, like 0.972, 0.982, minus 0.97, okay, then it will be considered as not weak form. It will be considered as inefficient market. Okay, so we'll see the we have seen the concept here. Now we'll see questions of it. Only one question is given in the module. Okay, we'll just solve it and move on to the next chapter. So how do we do it? First, see, Mr. X is of the opinion that the market has recently shown weak form of market efficiency. In order to test the validity of his impression, he has collected the following data relating to the movement of the Sensex for the last 20 days. Okay, 20 days data is given. Okay, so here there are more values given: opening value, high value, low value. Is that anything relevant for me? No, just the end of the closing price is the relevant value for me. So we'll take only this. Okay, only the closing value is my relevant part in this question. Okay, you are required to test the weak form of efficiency using autocorrelation test, taking time lag of 10 days. Okay, so they have told it in the question that 10 days. So we'll divide it by 2. Okay, 20 divided by 2, it is 10. Okay, so period 1 we'll treat it as separate share. Okay, this 10 days will treat it as one share, and period 2 will treat it as another share. So closing price is given. Since the first day of the thing is only relevant for me, okay, we cannot calculate the prices here. Okay, we cannot calculate the returns here. So we cannot do the first day. Okay, and 11th day also we cannot do. So for the rest of the period we'll do. Okay, now they have given here in percentage. Okay, this percentage part is I don't like it. So we'll see the alternative solution. That is, we put the prices here. Okay, and change we'll do it in numerical value. Okay, so minus 1.96, this is the changes that is occurring. Okay, that is 33,434 minus your 33,453. Okay, that is 19.16. Okay, like that you have to do changes of all. Okay, then second price we do change of all. Okay, then we'll do we got X value, we got Y value. Okay, we'll treat it as separate shares, right? So we'll do x. Since this is deviations, so we'll do square of it. Okay, we'll square it, right? And we'll do x minus x into y. This is my covariance, right? So what is the formula of correlation? Correlation is that is denoted by r ab. Okay, let's suppose ab or xy, whatever. So cob ab divided by standard deviation of 1 a into standard deviation of b, right? So here we got covariance here. Okay, xy we got, and we'll divide it by the number of days, that is 10. Okay, so we'll get an amount here. And then what we have to do, we have to, in bottom, what we have to do, standard deviation. So here total divide by 10. Okay, we'll get variance. Okay, and if you do square root, we'll get standard deviation of both the squares. Okay, of both the securities. Okay, then we can find r. Okay, so it is very much easy. If you have done portfolio chapter, then you will be able to solve it. Okay, but this will not be asked in exam since it has more calculation. Okay, so that's it for today and this chapter. Revise it well. We'll start with mutual funds in the next lecture. Tata, bye bye.